Mr. Carstens, can I ask you to also stay on stage at this end of the stage, because you were part of that very first discussion. If you would like to take the seat here, thank you. Ladies and gentlemen, our Financial Secretary, Paul Chan, has to leave us now due to other engagements, but let's have a round of applause to thank him for joining us this morning. Well, the global economy, as we've already heard and as we all know, is grappling with multiple challenges of inflation, financial stability, and growth not seen in decades. Inflationary pressure has proven more resilient than expected on the back of resilient labor markets and in an increasingly fragmented global economy. The higher for longer interest rate environment needed to combat inflation has exposed financial vulnerabilities built up over the last decade, and that poses risks to the growth outlook and to financial stability. So what are the policy trade-offs for central banks, and how can they best calibrate their policy tools in the period ahead to meet some of these global challenges? Well, we have several governors who will share their thinking about this with us in our first panel. Leading the panel, we thank again Mr. Agustín Carstens, General Manager of Bank for International Settlements. And I'd like to welcome our other panelists to the stage. They are Michele Bullock, Governor of Reserve Bank of Australia, Pablo Hernandez Ducos, Governor of the Bank of Spain, Dave Ramsden, Deputy Governor of the Bank of England, and Governor Setaput from the Bank of Thailand. Please welcome them all. Thank you, Mr. Carstens.
Well, welcome all of you to this opening panel for this HKMA BIS high-level conference. Before proceeding further, I would like to remind you that this session is on the record and will be live streamed. We have definitely, we definitely have a stellar panel today, really distinguished colleagues of mine, and I'm sure that we will have a really rich conversation today. The objective of this panel is to sort of set the stage for our further discussions. And in a way, this has to do with basically assessing where the global economy is, and in that context, where central banks are in the pursuit of a lower and stable inflation. Since 2020, we have faced a very convoluted world. Needless to say, COVID-19, huge shock that affected all aspects of society, including the tasks that are commended to central banks. If we recall where we were at the beginning of COVID, we were coming from a period of very low inflation. Many central banks, as a matter of fact, trying to bring inflation up to their targets, quite unusual state of affairs. COVID-19 hit. We decided, well, the humanity decided, as a way to combat COVID, to put the economic activity under animated suspension. I mean, it was decided that we needed to pretty much close the economies to combat the pandemic. Of course, that was a major aspect in affecting economic prospects as we move forward. That invited very aggressive macro policies, both in the fiscal and monetary side, because we were fearing a major depression. If you decide to close down all the economies, economic activity needlessly was going to suffer. The good news is that we had a relatively quick rebound. We have the vaccination. Economies came back strongly. And two things I would say at least combined to make our life difficult in inflation. First, to turn back on the economies is not as simple as turning on and off light. Many aspects of in value chains, productive activities were distorted, and that ended up affecting, generating dislocation, affecting growth, but also generating inflation. We also had a very quick recovery, and that meant that the stimulative programs, both on the monetary and fiscal side, turned out to be too expansionary. Then we had an additional shock, which was in commodities as a result of the Russian invasion to the Ukraine. Starting in 2021, we saw a very sharp increase in inflation, and the central banks, needless to say, acted quickly to try to bring inflation under control, bring it back to the 2% target. We know, or 2% or 3%, I mean, each country has its own target. We know that this process is lengthy. So far, after some months of very intense monetary tightening, I have to say that we have seen a pretty good progress. Pretty much all the transitory components have been worked out, and the core inflation still remains relatively high, but some progress is being made there. We're in an interesting moment in the monetary policy implementation, a very speedy increase in interest rates. Now the dilemma, the complexity that is always there is that you tighten monetary policy and the transmission mechanism is not immediate. So we're at the stage where in most latitudes the hike in interest rates have been substantial, and we still have to see what the impact on inflation will be. So we will have a 6 to 9 months period where we will see how sufficient has been the tightening that we have seen so far. Usually when you tighten, there are consequences on three important dimensions in the economy. First, employment and economic activity. Second, financial stability. Third, it has an impact also on debt and public finances. I would say in the three areas, effects have been felt. The economy has been slowing down. Employment hasn't been growing as much. But I have to say, at least in my own perception, according to our analysis, the impact has been less severe than what we anticipated. Nevertheless, the outlook is still a little bit weak as we move forward. Financial stability so far has been quite good. We had some hiccups at the beginning of this year, but they turned out to be idiosyncratic. But, still the way is to go. In the next 9 months or so, we will see, again, a period of high. I mean, we still see an indefinite time of high interest rates, higher real rates, lower economic growth. So that also can have an impact on financial stability. And of course, public and corporate debt is high. Now with higher interest rates, this will also complicate matters. So there are many, many challenges. I would say so far we are on a good trajectory, but the way forward is not necessarily so smooth. In the future, we'll have less growth, probably some volatility, and of course, we central banks need to be really persistent in fighting inflation. So with this introduction, I would like now to turn to the panelists. We have everything has been time to the second. So I would appreciate if in relatively 3 to 4 minutes you can give us your thoughts of where you are in this process of disinflation. Obviously, you can accentuate whatever aspect you think is pertinent in your case. So, ladies first, so let me give the floor to Michele. Please, Michele, the floor is yours.
Thank you very much, Agustín. So I'll highlight a couple of things. The first is that, in some sense, our path of inflation has been very similar to that overseas. Inflation peaked at around about 8%. It's since come down over the last 9 months to be a bit over 5%, both in headline and core terms. Like overseas, a lot of that's been driven by declining goods price inflation, and what we're observing is that services price inflation is quite sticky. What we're forecasting is that inflation will come down to about 3.5% by the end of next year, and then a bit under 3% by the end of 2025. Now, for those of you who don't know, our inflation target is between 2 and 3%, and we sort of obviously would like to aim for about the middle of that band, but it's flexible in the sense that we've got a bit of a band. The thing I'd highlight, though, is that it is very uncertain. There are big ranges. Everyone's seen the fan charts that a lot of central banks produce, and ours are no different. There's a wide range of uncertainties and experiences there. And I'd have to say that we've been a little surprised on the upside recently in this sense. We've been surprised by a little bit on the strength of activity. It's held up a little better than we'd thought. That's meant that services price inflation has held up a bit more. So what we're observing is a bit more domestic price pressures than we'd expected. So that really is the challenge going forward. We have, like other countries, raised interest rates much more quickly than we have in the past. And that has created, in fact, a lot of political noise and a lot of noise from the general public. Australia, for those of you who don't know, has a predominantly floating rate mortgage system, and that means that interest rate rises flow through very quickly, and it flows through quickly to those who have mortgages, and that's around about 45% of the population do have a mortgage in some sense, either over their own home or in an investment property. And that's created a lot of noise. People are very unhappy. The cash flow channel works very quickly in Australia, and it's very prominent. But what I'd like to highlight here is, though, despite that noise, households and businesses in Australia are actually in a pretty good position. Their balance sheets are pretty good. Through the pandemic, they built up large buffers, large savings buffers, and they're largely still intact. Housing prices are rising again, much to everyone's surprise, so that's sort of helping people feel a little bit more wealthy. There were also very prudent lending standards through this period. So debt-to-income, high debt-to-income loans have a really small proportion of lending, as are high LVR lending. And there was an interest rate buffer imposed of around about 3%. So a debt serviceability buffer, if you like, of 3%. So there's been some good prudent lending going on here. And that's evidenced by low arrears rates so far. And those who are coming off very low fixed rate mortgages, they're managing quite well. And all the indications from the banks and all we hear from the banks is these households are doing fine. So actually, from a financial stability perspective, this all looks rather good. And I'd have to say, though, that employment is the key here. We still have, although the labour market has eased, it still is a pretty tight labour market. People are getting work, and that's really important for people being able to pay their mortgages. That said, there are distributional consequences, and we are dealing with the political economy challenges of the distributional issues associated with raising interest rates. So I think the challenge for us now is really to continue to make sure that we keep pressure on make sure that we don't let inflation expectations get ahead. They're not at the moment. They are remaining relatively well anchored. But the challenge is to do that at the same time as we don't end up with a large increase in unemployment. Continued employment is really important. It's important for our dual mandate, obviously. We care about it. It's also important for people being able to continue to meet their mortgage repayments and their essential living expenses. So we're in a period now where we have to be a little bit careful. We want to make sure that we keep inflation under control and we bring it back down to our band, but we also need to make sure we do that in a context of not imposing on the economy too much and raising the unemployment rate so much. So that for us is our challenge. So thanks, Agustín.
Excellent. Thank you very much, Michele. Now let me give the floor to Pablo.
Thank you very much, Agustín. I mean, from the perspective of the euro area and focusing on monetary policy, perhaps the question of where we are should be answered by this communication, this statement that we did already after our meeting in September, but we also repeated in October when we decided to keep rates unchanged, which is basically that our current assessment is that the current level of interest rates, if maintained for sufficiently long duration, might be sufficient to reach our target of 2% in the medium run. And this is an important statement because, in my view, it contains the three main elements of how we see, or at least how I see, the situation in the euro area. The first one is clearly that our forecast, the forecast that was produced by the staff in September, was anticipating a decline of inflation, a gradual decline of inflation towards our 2% target in 2025. And this was justified for several reasons. Some of them were mentioned by you, Agustín, in your initial remarks. Of course, the fact that a significant part, at least in the euro area, of the increase in inflation in 2022 was due to energy prices and food prices, and these energy prices and food prices have declined in a significant manner, and this is, of course, being transmitted and is expected to be transmitted to underlying inflation also in the following quarters. Of course, demand is weakening. Not only because, of course, the recovery after the pandemic has vanished, but also because of monetary policy transmission is affecting demand as expected, and is expected also to affect demand in the future. Fiscal policy, our expectation is that it might turn restrictive in 2024 and 2025, because, of course, as you can imagine, after the significant increase in deficits and debts after the pandemic, and hopefully with an agreement on the Stability and Growth Pact, there will be a need for many countries to enter into this restrictive territory in order to provide sound public finances in the future. So the reasons for, of course, the unwinding of supply bottlenecks is also an important factor. This is the first element that it is behind this statement. I think it's also important to emphasize that we've also gained a lot of confidence in our forecast. It is true that in 2022 our forecast errors were very significant and always surprising us, inflation on the upside. But it is also true that in the last 3 quarters, inflation has behaved in a very similar manner as the staff was projecting initially. And indeed, even for core inflation has evolved even better in terms of being lower than initially expected by the forecast. I think this is also important. The second element behind this statement is, of course, that behind these inflation projections are the financial conditions that were prevalent in September when the forecast was produced. And financial conditions today are not very different to those that were present in September, meaning that the market is indeed expecting us to be persistent in our current level of rates. So our statement, several members of the Governing Council saying that it is too premature to talk about rate cuts is, of course, also the view of the market. But at the same time, of course, at some point there is also some inversion of the rate increases in the expectation of the market. But to me, this is also a confidence given by the market that at some point we might be reaching our target. And of course, given that our current level of rates is in restrictive territory, we might come back at some point. We should come back at some point also to neutral level. But of course, this is not to be anticipated in the short run. And the third element that it is important to emphasize in this statement is the conditionality. This is a conditional statement, which is absolutely crucial in a context, as you were saying, Agustín, that uncertainty is very high. There are many risks in the horizon. For me, probably the most important one is the geopolitical risk, and in particular, those derived from the war in Middle East, to what extent this might be extended to other countries. This is not, of course, the expectation today, but this might happen. If in the end this happens, this would lead to a new negative supply shock, which, of course, for the euro area economy would be a new terms of trade shock, as the one that we had last year. And then the implications of this new negative shock to the economies are not obvious, and in particular for medium-term inflation. It was very clear last year that the negative supply shock in a context on which demand was recovering very quickly, on a context on which monetary policy was restrictive, of course, the implication for inflation was that the fact, not only for the short run, but even for the medium run, was high inflation, and this is why monetary policy had to react in a very significant manner. But of course, now the context is completely different. Demand is weakening. We cannot even exclude the possibility of having negative numbers also for Q4 in the euro area. Of course, monetary policy now, as I was saying, is in restrictive territory. This means that potentially the implication of this negative supply shock on the medium run on inflation might be different to those that we were anticipating last year. But at the same time, if this negative supply shock materializes, then it will happen and after a context of very high inflation for several years. And therefore, also the likelihood of the anchoring of inflation expectations might be higher, and therefore also the implications for inflation in the medium run might also be more significant. So again, a lot of uncertainty, which again emphasizes the point that we are also emphasizing, which is the data dependency of our monetary policy in this context. Thank you.
Thank you very much, Pablo, for giving us this very complete view out of the Eurozone. Let's stay now in Europe. And let me give the floor to David. Please, David, the floor is yours.
Hi, and it's a great honor to be invited to speak on this panel. I'll also focus on monetary policy as we're in the middle of a financial policy committee round back at the Bank of England. UK inflation peaked at 11.1% a year ago, but it actually remained above 10% until this April, reflecting the cumulative impact of the two unprecedented global shocks that Agustín set out. And inflation initially worked through imported goods prices, energy and food prices. But since this April, UK inflation has started to fall back sharply as energy prices in particular have come down, and headline inflation was 4.6% in October. Core inflation was 5.7%. But it's fair to say that inflation has proved more persistent than successive MPC forecasts. And in our latest forecast, published at the beginning of November, inflation is projected to be back at our target by the end of 2025. But in the forecast we made a year ago, inflation was projected to be back at target much faster by the end of next year. Now, the main drivers of that persistence have come from the tightness of the labour market, both from lower supply of labour and higher demand. In turn, we've seen strength in pay growth, which was still over 7% in Q3, and this has driven services inflation, which has stayed very elevated at 6.6% in October. And in this way, UK inflation has become much more homegrown. Meanwhile, demand has been more resilient than we expected. supported by that fallback in energy prices as well as fiscal support and by the tightness of the labour market. Now, against this backdrop, the MPC has raised bank rate from a low of 0.1% 2 years ago to 5.25% now. And at our recent meetings, including at our latest meeting in November, where we maintained bank rate at 5.25%, we have focused on that persistence. And the MPC has also emphasised that we think monetary policy is in restrictive territory. Now, there are different ways of thinking about restrictiveness, but for me, the most straightforward explanation is to think of it as the impact policy is having on holding demand in the economy lower than it would otherwise be relative to supply. We think that just over half of the impact of the tightening we've done to date is still to come through. But this restrictive stance will contribute to headline inflation falling further. It's forecast to be below 4% by next March and down to 3% by the end of next year, and back at the 2% target by the end of 2025. But it is notable that it takes 2 years from where we are now to get inflation back to target. Now, in the MPC's latest forecast, GDP growth is actually projected to flatline through to the end of 2024, which reflects that the impact of restrictive monetary policy. Now, as Michele and Pablo have set out, there remain many uncertainties, but I'm becoming more confident about the outlook. And based on those latest projections, we think that monetary policy is likely to need to be restrictive for an extended period of time. And we've communicated that it will need to be sufficiently restrictive for sufficiently long to get inflation back to the 2% target, which is in line with the remit we've been given. And financial markets have internalized that message from us and other central banks that policy rates are going to have to stay higher for longer relative to previous expectations. But one thing I find noteworthy is the volatility of rates markets and their sensitivity to data releases and other developments. And we've been seeing that in recent days and weeks. And markets, as always, are entitled to make and to change their assessment of the future. And it may be that their expectations are underpinned by a different view about prospects than policymakers. One thing that distinguishes our forecasts on the MPC from many others is the weakness of potential supply growth, or the speed limit at which the economy can grow on the demand side without pushing up inflation. For the UK, we're therefore projecting a challenging path for the economy, one of subdued growth, stubbornly high inflation, and some pickup in unemployment. However, as Eddie Hughes said at last night's dinner, monetary stability and financial stability are the foundations for sustainable growth, and will ensure that inflation does return sustainably to the 2% target in the medium term. And I'll stop there.
Thank you very much, David. Now let me give the floor to Setraput, please.
Thank you, Agustín. First, let me say I'm going to be constrained in what I can say, and I won't talk about the outlook because we have an MPC meeting coming up this week. In fact, it's tomorrow, and normally I would not be speaking anywhere or even traveling, but I could not miss the opportunity to come and wish Eddie happy 30th anniversary, because the HKMA and Eddie and his colleagues have been such wonderful partners for us all throughout with us at the Bank of Thailand. So let me offer by way of substitute a look back in terms of our inflation path and our policy response and what impact that's had on our financial conditions in Thailand. Headline inflation in Thailand peaked last year at 8%, almost 8% in August, and core peaked at about 3.2% in December. So we're in terms of inflation, we're actually among the highest in the region. But we experienced a fairly rapid disinflation. Inflation started to come down quite rapidly. It came back within our 1% to 3% target by about March in terms of headline. And the latest outturn in headline inflation in Thailand is actually negative now. The latest outturn was minus 0.3%. That figure is a bit misleading because it includes a bunch of government fuel and electricity subsidies. So you strip out that stuff, headline will be coming out at about plus 0.9, core running at about plus 0.7. So inflation has come down quite rapidly, and it's been in Thailand for a bunch of reasons that we can go into. That word that people want to avoid a lot, it was transitory. We didn't see that much persistence in terms of inflation. So our policy response as a result was more what we called gradual and measured. We didn't feel the need to do such aggressive rate hikes as some of our other countries have had to do. We tightened rates from 0.5% to 2.5% in 25 basis point increments. We felt that it was a gradual and measured response. The public and the borrowers did not feel that way, as I think many of you understand. But it has resulted in a moderate tightening overall in terms of financial conditions in Thailand. But again, in aggregate terms, fairly moderate. The pass-through this time in terms of rate tightening onto M rates was on the order of about 60-odd%, so a bit higher than in previous cycles. And we've seen a slowdown in credit growth as well. And also, but one thing that's helped to offset some of the tightening on the monetary side has been a depreciation of the exchange rate. In Thailand, I think as with many countries around the region, when the exchange rate depreciates, that tends to have a loosening impact on financial conditions. We don't have a whole lot of foreign debt, and we have obviously a lot of exporters and whatnot. So when the currency depreciates, the financial on net tends to lead to a loosening of financial conditions. So overall, in terms of the aggregate picture, in terms of financial conditions, have been one where I would say, again, a picture of moderate tightening. But that aggregate moderate tightening, I think, obscures a lot of differences. I mean, the impact has been very, very heterogeneous. So, for example, while in aggregate it's been relatively moderate, certain sectors, particularly with the SMEs, I think have seen much more tightening. We see that because SMEs in Thailand, as I'm sure across the region, they don't tend to have a lot of fixed rate, long-term debt. A lot of their debt is short-term and floating rate, so they get hit a lot harder with these rate hikes that we pass through, and also a lot of the targeted credit measures that we put in place during COVID, these targeted credit to help SMEs and whatnot, expired. And so the credit growth, which was actually positive during COVID, now has turned negative for SMEs. So the tightening impact has been fairly heterogeneous. In terms of the overall impact of this tightening and on the overall economy, latest outturn in terms of Q3 GDP was somewhat disappointing. It came out at 1.5% growth. But domestic consumption has held up quite substantially, quite well all throughout. Third quarter, private consumption grew at about 8%, and year to date it was like on the order of about 7+%. A lot of, again, in Thailand, our outlook and our recovery is very conditional what happens on tourism, similar also to in Hong Kong. And while we've seen a reasonable pickup in tourists in Thailand, with the exception of Chinese tourists who have not been coming back. One thing that's also noticeable is the spending is down. So that in terms of the tourists that come, but they're clearly spending less. The spending per trip is down, and it's down about, ballpark, about 75%. They're staying shorter, and they're spending less. So let me stop there.
Thank you very much, Sataput. Let me now focus a little bit more on very specific issues or more specific issues and allow our panelists to elaborate more on some topics. After this round, we will move to open the floor for Q&A from the audience. Again, let me start with you, Michele. You had a very, I would say, interesting and I would say intense start as governor. You needed to tighten monetary policy immediately. I think that was, in a way, hopefully at the end it will be a blessing in disguise, because you have established your strong commitment and determination in observing your objective. Now, the very specific question is, why do you think inflation has proven to be stickier in Australia than what we used to have in the past? Does this have to do with the transmission of interest rates to inflation?
So as I said earlier, I think it's about demand being a little bit stronger than we had anticipated, and certainly more than we had forecast. There's a few things going on here. I think we talk a lot about supply shocks and energy price shocks, and in Australia also we've had sort of rents going up and insurance. Now these are things that monetary policy can't necessarily do anything about, but I think it emphasises the potential importance of second round impacts. And I think what we've been observing is that some of these costs, along with wages haven't got completely out of control in Australia. They're running at about 4%. But without any productivity growth, that's actually resulting in a reasonable increase in unit labour costs in Australia. So what I think we're starting to observe is second round effects of some of these costs. Businesses are finding that demand is sufficient that they are able to pass those costs through. They therefore are maintaining their margins. And that's what's sort of meaning that services price inflation in particular is quite sticky. We do observe that people are, households and individuals are slowing their spending, some a little more than others. The evidence is that younger age groups are slowing their spending a little bit more than older age groups. Some of the things that are impacting on younger age groups, of course, are rents are rising very quickly in Australia, and this is quite a separate issue. It's to do with supply of housing. During the pandemic, we had an accelerated reduction in household size. This is something that's been happening for some time, but it accelerated somewhat, which has increased the demand for housing at the same time as supply hasn't really responded. So that's impacting particularly younger people, I think, and lower income people. So they're starting. So we are seeing discretionary spending come in, but it still seems that there is enough of it out there that it's meaning that businesses can maintain their margins. The other thing that's going on is that we've had very strong immigration in Australia, and even though we see consumption per person declining, in total, consumption has held up. It's not particularly strong, but nevertheless, it's strong enough. And I think that has also meant that demand has held up. The caveat I'd add to that is that at the same time as immigration has added to demand, it's also added to supply, because we've had a very tight labour market. And in fact, as we were coming out of the pandemic, that was one of the cries of businesses. They couldn't get labour, and they wanted immigration to get labour. So it just demonstrates, I think, that there's two sides to many of these stories. So while immigration has added to demand, it's also added to supply. It's added to supply for labour. So I think that's the reason why we're seeing services price inflation quite sticky in Australia. But again, we do think that monetary policy is restrictive, and that it is going to, and we're seeing it actually have a dampening impact on demand, and that will help.
Well, thank you very much. You really have shown tremendous nimbleness and flexibility, and that fares well for Australia in the future. Let me now go to Pablo again, but I will take advantage of the fact that he is the chairman of the Basel Committee on Bank Supervision. He gave us already a very complete view on Europe. I think it would be very interesting for this audience to hear your views of the challenges in the banking system particularly from the point of view of financial stability, given that higher interest rates certainly mean more pressure on the financial system, in particular the banking system. So how do you see things? How are challenges? All in 3 to 5 minutes at the most.
Yeah, no, thank you. Thank you very much, Agustín. The interesting thing about the Basel Committee, what I've learned in the last 5 years chairing the Basel Committee, and I have Arthur here, who is a very prominent member of the committee, is that there is always a mix in the analysis that we do of having a forward-looking perspective, always trying to scan the horizon, no, and to see where the risks are, but at the same time also trying to learn from the different experiences that we have. No? And to answer to your question is probably you need, Agustín, probably a mix of the two. No? On the one hand, it's clear when you look you look to the future that for sure the current environment of very significant increases in interest rates in a very short period of time, it has created for many banks high profitability. But we know that this is probably only a short run effect, that at some point credit risk might also materialize, and that there might be losses also in some of the assets. So this is why, from the perspective of the Basel Committee, we are sending the message that the banking sector should remain very prudent, and even you could even claim that they should use even the profitability, the high profitability that we are observing, in order to increase resilience, not even to keep resilience, to maintain resilience, but even to increase resilience. At the same time, many of the risks that we observe and that we identify for the banking sector are more structural, not so much conjunctural, and are derived from climate change or digitalization. And this is also the focus of the committee, and we are precisely now working very hard on trying to identify how to mitigate, from the perspective of the banks and from the supervisory and regulatory perspective, how to help the banks to internalize those risks. But this is the forward-looking perspective, but we have also to take into account the backward-looking perspective. And here let me mention at least 3 elements that for me are relevant. The first one is, of course, the lessons learned from the global financial crisis. Of course, many of the reforms that were identified have already been implemented, but it is also true that the last mile of this reform, which is Basel III, the one that was agreed in 2017, this has not been implemented in many jurisdictions. It has been implemented in Asia, mostly, and in full and in a timely manner, but this is not the case, for example, in 2 main jurisdictions, such as the US and Europe. So the key message here for us is to still send the message that this is absolutely crucial, that this implementation is done and is done as soon as possible. Then second, when the pandemic came, we also tried to analyze the implications of this exogenous shock into the banking sector, and to what extent the regulation and the supervision that we had worked as intended. And perhaps here, well, we produced a report that was published in 2022, but perhaps one message that for me was relevant is this idea of, well, some doubts about the usability of the capital buffers that the banks have been accumulating over time. And we introduced this idea, and some jurisdictions are going into this direction, of positive neutral countercyclical buffer, that basically means that even if there are not financial stability risks that are emerging that would lead to jurisdictions to increase the countercyclical buffer, still it would make sense to have, when the output gap is 0, to have a positive neutral CCYB that in the end could be used and could be released if when risks materialize, in particular, for example, when exogenous shocks materialize. No? It's not that we are obliging the jurisdictions to go in this direction, but we are sending the message that this could be a good idea, and many jurisdictions are indeed doing so. And of course, the third element that it is important is, of course, the turmoil that took place in March. We have also analyzed this in a very deep manner. We have already published a few weeks ago a document, and here the two main messages that I would like to send is first that there is a need for a strong supervision. And there are several elements on how we are currently supervising the banks that we need to change or at least to strengthen. For me, perhaps the most important one is this analysis of the sustainability of the business models of the banks. Something that has always been very relevant, but with all these structural changes taking place and affecting the banking sector, the supervisors to also have a very prominent role in this analysis, I think is important. It's not only important to do the analysis, but also once that you reach a conclusion and you identify an outlier bank, also to force the bank to do what you want to do. And here, of course, is a tricky issue because, of course, you want to do it without co-owning the bank, no? And the tools that many supervisors have in order to force the bank to do what they want to be done is not always there. And then, of course, there are some issues on regulation that we need to analyze more deeper. And here is, of course, interest rate risk in the banking book, is liquidity risk. This is probably the most novel one because, well, the speed in the velocity of the outflows of deposits has surprised us, and this is a material change for the banking sector, and we need to analyze how to deal with this in the future. But it is also about the definition of capital, this issue of AT1s, and to what extent they are playing the role that was intended when this instrument was introduced, or even the scope of implementation of Basel III. As you perfectly know, Basel is expected to be applied only to international active banks. Well, the reality is that, I mean, these banks that fail in the US didn't have an international role in terms of their activities, but still they created a significant contagious in other markets. So maybe we have to also think about whether this definition or this scope of implementation of the current regulation is the right one. Thank you.
Thank you very much, Pablo. Very complete answer. Let me now go back to you, David. Certainly, the Bank of England has taken very decisive action to help inflation subside significantly. You have been using also actively QT on top of raising bank rate. What has been the experience? Do you think this represents or adds to the flexibility in adjusting policy? And you know, do you think that this has raised any issues related to financial stability and market volatility?
Thanks for that question, because it enables me to talk about something that we've been carrying on in the background, as it were, in terms of our monetary policy actions. We first actually set out our strategy on QT back in August 2021, very much focused on three principles, all designed to keep QT operating, but operating in the background, as I said. So first of all, we very much see bank rate as the active policy tool when we're adjusting the stance of monetary policy. Second, we really try and ensure that the sales that we do are conducted so as not to disrupt the functioning of financial markets. And third, to help achieve that, we take a very deliberate approach and conduct those sales in a gradual and predictable manner over a sustained period of time. And I think from what I was saying in my first intervention, you can see the contrast with our approach to bank rate. And really our preference for using bank rate in most circumstances is primarily because there's greater certainty. We've got a long experience of using bank rate. We understand how it affects the economy compared with these other policy tools. It's also operationally easier and quicker to implement. But although QT is designed to operate in the background, it does have a really important benefit of reducing the ratchet upwards in the size of our balance sheet over time. And as we've seen over many years, being at the effective lower bound on interest rates, we've ended up at the bank, as many central banks have, with a very large balance sheet. And so by reducing that, we increase the headroom and flexibility for us to use the balance sheet in future, both in pursuit of our monetary, but also our financial stability remits. Now, in practice, we have followed the deliberative approach that I set out in terms of our principles. We actually commenced QT back in February 2022, initially through maturities, but we have a relatively high average maturity in our portfolio. And as of September 2022, the MPC voted to reduce the stock of gilts that we hold in a separate asset purchase facility through a combination of maturities, but also sales, initially by 80 billion. And then this September, we increased that reduction in the stock to 100 billion pounds. And that will take the size of the APF by next September down to a total of 658 billion pounds. And that compares with a peak of 895 billion in December 2021. So that's quite a fall. Now, gilt yields have, of course, risen over the period since we started doing QT, but the vast majority of the 300 basis point increase in, say, the 10-year gilt yield has been driven by increases in expected policy rates. We use a range of models produced by our staff that do suggest that changes in term premia have contributed to the more recent moves in long-term global yields. And QT may, of course, be one contributing factor there. For example, any portfolio balance channel of QT would be expected to show up in the term premia. But we're confident that QT is very unlikely to be the main driver of those increases in term premia. So the evidence we have to date supports our expectation that QT impacts, while greater than zero, are materially smaller than the effects of QE were on average. So we would estimate that the additional 80 billion of QT relative to a counterfactual is likely to increase 10-year gilt yields by less than 10 basis points in prevailing market conditions. And remember that principle of when we would actually do the QT. And that would map across into an impact on activity and inflation of less than 0.2% and 0.1% respectively. And so while there may be some QT impacts coming through, and this is an important point, the MPC can observe those effects on asset prices because they should be priced in to markets given our approach, and we can condition our forecasts accordingly, and therefore we do have the flexibility to adjust our active tool to the extent that any complementary or offsetting action is deemed necessary. So I wouldn't say there's any indication that it's made it harder to calibrate the monetary tightening, and I think we do have that flexibility of two tools. And we haven't seen, to your final point, Agustín, we haven't seen any financial market stability concerns emerge. And that's supported by very close quantitative and qualitative market monitoring that we undertake. We do event studies around QT auctions, and these point to very limited impact from the specific sales that we're doing. And we've also observed very little impact of unwind on market functioning. Indeed, there's actually been some signs of a positive effect by alleviating collateral scarcity at the shorter maturities that we're selling back into the market. A final comment, so I wouldn't see any financial stability grounds for adjusting our approach to QT or indeed to our setting of the level of interest rates as I was discussing earlier. And I'll stop there.
Thank you very much, David, for this very good answer. And it really enlightened us about how to use these two instruments together. Let me now turn to Sethaput. Certainly Thailand is in a different position than many other economies as inflation is more or less on target. Is the difference in inflationary conditions between Thailand and advanced economies creating any challenges for your implementation of monetary policy, for example, through its effect on capital flows and the exchange rate?
Yeah, we've seen a step increase in volatility in exchange rates from pre-COVID. Pre-COVID exchange rate, the baht dollar rate volatility was about 3-4%. Recently, it's been tracking closer to 8-9%, and typically we're like a bit more volatile than the other kind of ASEAN neighbors, but lower than that of, say, Korea and Japan. But now we're getting closer to Korean levels. I know Chang Yong is here. Happy to follow in his footsteps in many things, but not in this regard. I think there are a bunch of reasons for that. A lot of the volatility has obviously been driven by uncertainty about what's been going on with the major economies' policy decisions, but that doesn't explain why we are relatively more volatile than other countries as well. And there are a couple of reasons in the case of Thailand, which are kind of more Thai idiosyncratic. We're also very correlated with the yuan, because Thailand is seen as being very tied to China's fortunes in terms of tourism and exports and whatnot. And also, Thai people like to buy and sell gold, so we've been very highly correlated, much more so than other Asian currencies, with the price of gold, and that's been contributing to our volatility as well. Not to mention, obviously, this year we experienced a fair amount of both political and policy uncertainty. So those things have been contributing to our exchange rate volatility. The good news is that I think it's relatively manageable for us still, and largely again to do with initial conditions have been quite favorable. We have, again, good buffers, good level of international reserves, certainly relative to our external debt. Current account position should swing back into surplus. So on the external vulnerability front, we're relatively okay and in a pretty decent position to handle the volatility. Non-resident participation in our equity and bond markets is relatively low compared to other countries in the region as well. That said, I think it's important not to be too sanguine. One of the things that's probably contributing to this kind of step increase in volatility in exchange rate is the fact that our rates are ending up lower than the U.S. Looks like it will be that way. I think for not just in Thailand, but I think for a lot of emerging markets in Asia, which I think is something we haven't seen before. And I think we're entering a period of kind of uncharted territory. We don't have really good long historical precedent of a situation where interest rates in emerging markets, particularly in Asia, are significantly lower, and will look like they're going to stay that way compared to advanced economies, and that I think presages some challenges on the exchange rate and capital flow front.
Thank you very much, Sethaput. Well, we have had a really brilliant set of interventions, giving you a very full description of how the challenges are manifesting themselves in different central banks. We have been a little bit late, but I think we can take a little bit of time of the coffee break, and we probably could entertain a couple of questions if there is anybody who would really want to make a question. Yes, please. There.
Perhaps I can ask a question regarding QT. So currently, in the current environment, there are, some of the developed economies have a very high fiscal deficit. So there will be a lot more supply of bonds that will come to the market. It may or may not drain some of the liquidity. And how do you think about QT in that type of context?
David?
I think it's fair to say, from a Bank of England perspective, that we are conscious of the issuance that's going to be taking place from a range of advanced economies, including from within the UK, and we had our own fiscal announcement last week. But the way we think about it is that what we should be doing with our quantitative tightening is to follow the principles that I set out. So if we follow those principles, and so far, as I tried to set out, I think we've achieved that. There may be some additional impact on term premium alongside the impact you would get from issuance, but we think that, and I gave the estimates in my earlier intervention, that's really relatively small, about 10 basis points for, say, 80 billion of QT. So that is an additional factor to take account of, but as long as we take this deliberate approach, go about QT in a gradual and predictable way, don't do QT, for example, when there is very adverse market functioning, and we haven't seen that actually since we started the active sales late last year. We can continue with our program and meet our objectives alongside whatever's happening on the issuance front. Thank you.
Thank you very much, Dave. Let me ask this last question. Making use of technology, we received some questions here. I just choosing the very first one, first come, first serve. And it's a very broad and interesting question. The question is pretty much, we have come from a period of very low interest rates, very low for long. That certainly affected the borrowing attitude of corporations and governments. Now that we're moving to a period of higher for longer, what is your assessment according to your experience and your circumstances? How will this affect economic activity and financial stability? Of course, this question could really benefit from a whole conference in itself. But let me ask our very skilled panelists to try to give an impression in a matter of 1 or 2 minutes. Let me start with you, Michele.
Just speaking from Australia's perspective, I mentioned earlier about notwithstanding the period of very low interest rates and the increase in borrowing, the Australian household and business balance sheets are actually in pretty good shape. So I'm not actually particularly concerned from a financial stability perspective about that. The other thing from the government perspective is that yes, we have had an increase in borrowing. Our debt levels are not really at about 35% of GDP. They're not really high. And one thing that we have benefited from, of course, is high commodity prices, and that's been of benefit to the government budget. And in fact, the government has a surplus this year, quite a good surplus, and they have banked the revenues. So I think in our case, I'm not particularly concerned about the particular balance sheet implications. Having said that, it's true that one of the major expenses for the government going forward is their borrowing costs, and that's going to continue to weigh on the budget.
Thank you very much. Pablo?
Yeah, very much along the same lines. And for me, the main concern is the combination of this, high for longer. It's obvious, no, when you look at the 10-year rates, that they are significantly higher than the ones that the market were expecting in 2019, so before the pandemic. It's the combination of this with the fact, of course, that we are not expecting higher growth with these higher rates. So meaning that R minus G is probably now higher, and of course the implications for fiscal sustainability are obvious. And this is why, in this context, and after, of course, as I was mentioning before, and the significant increase in public debt levels in many countries, it's absolutely crucial to take fiscal consolidation seriously in order to guarantee the soundness of public finances, no? And to avoid also financial stability implications, negative financial stability implications coming from these debt levels.
Thank you, Pablo. Dave, I'm sorry.
Very similar position, I think, to that Michele and Pablo have set out. I mean, a couple of points that that really resonated. Household and business balance sheets in the UK are also looking resilient. Something that Pablo said in his previous intervention, I think it's really important to track the impact of higher for longer on banks' business models. You know, in the UK, we capitalise for interest rate risk on the bank's balance sheets, but also we're very focused on what's happening in non-bank financial institutions. The only thing I'd add on borrowing costs is I think it really, one thing that, and many of you will be aware of this, we had an issue last autumn, early autumn, when we had a very rapid increase in long-term yields that was seen as in part driven by a fiscal policy approach that the markets didn't perceive as being credible, and that because that included the fact that our fiscal council, the Office for Budget Responsibility, was not involved in putting together the forecasts that underpinned the fiscal announcements. And I think that really does underpin a period when you are seeing likelihood of interest rates higher for longer, the importance of institutions and the importance of transparency. And so being able to absolutely track what's happening to the borrowing costs of government or indeed the borrowing costs of household and businesses, it's really important, I think, that markets see that you're being completely transparent in the way you're presenting those developments. And I'll stop there.
Thank you very much, Dave. Setaput, please.
Yeah, the area that worries us most would be household debt. Household balance sheets are going into COVID or somewhat weak in Thailand. Household debt to GDP peaked at about 95%. Now it's down to about 90%. But again, you know, we've had inflation, and even though inflation has come down, the level of prices have increased. So the cost of living has gone up. So balance sheets are under pressure that way. And household debt is something that's very difficult to move. I think that by nature, the legacy debt, you know, it's just very, very slow moving, hard to get down. And tackling it is very challenging from a political economy standpoint. You have to do a lot of unpopular things, right? I mean, the kind of things that we would like to do to try to address that would be, you know, higher rates, tighter prudential stuff. All that stuff is not terribly popular. So it makes it that much more difficult to handle.
Well, thank you very much, Setaput. I will not try to summarize the discussion. Let me just say that we have witnessed very determined central banks having very clear in their minds where are they traveling and how are they doing, I think it's very reassuring, their commitment to bring inflation under control, and at the same time being very mindful about financial stability and employment issues. So let me ask you to join me giving a round of applause to our panelists. Thank you very much.
Thank you very much, Mr. Carstens, for leading that discussion. Could I ask our panel and Mr. Carstens to come forward and stand together for a group photo before you leave the stage?